Hi, welcome. Welcome to the Point Podcast. I'm your host, Rinn, and my guest is Tony Watson, enrolled agent with Robert Hall and Associate in Glendale, California. Tony focuses on providing personalized financial guidance and tax preparation services for individuals and businesses. Should a client need assistance with audits, collections, or appeals, Tony is empowered by the U.S. Department of Treasury to represent taxpayers before all administrative levels of the Internal Revenue Service. Tony is a keynote speaker for Robert Hall and Associates, and his dedication to his clients and expertise in the field of taxation led him to win the Glendale Reader's Choice of Awards for Best Tax Preparer in 2016. Tony, would you please share with us some of the new important tax changes for 2022 and some of the best tax strategies that you can recommend for realtors and obviously for self-employed people?
Absolutely. Thank you so much for having me. As far as 2022 is concerned, as of today, we don't have a final tax code, but we do have a pretty darn good idea of what's going to be changing. We're going to be seeing increased tax rates for the individual taxpayers, both single, head of household, married filing joint, married filing separate. But also on the corporate side, we're going to see a tax hike from 21% on the C corporate filings up to 28%, which is still much better than what the tax rate was prior to 2018, which was 35%. So we will see some increased brackets across the board for both individual tax filers and corporate tax filers. Some of the looming issues that haven't been finalized yet would be taxable income or taxable liability, additional liability on pass-through entity income, which would be rental property cash flow, income from S corporations and LLCs. A lot of that is still on the table for discussion at the government level, but none of that has passed at the moment. There has been talk about changing parts of the 1031 exchange, Section 1031 of the Internal Revenue Code. I read an article just yesterday that talked about tabling that discussion, which I'm really hoping and crossing my fingers on that they avoid that part of the Internal Revenue Code fully. But a lot of changes on the horizon, nothing set in stone as of today, but make no mistake that if even 50% of this tax bill passes, it will be the most significant change to the Internal Revenue Code, probably dating back almost 100 years. So it's very, very important for us all to really bear down and understand the tax code once we do have a final code in our hands.
Now, do you think I was reading it or getting emails that the IRS employed 70,000 new people. Now, did they do it for this reason because of all the changes happening in the tax codes and so forth?
So that there's a lot of concern about this particular topic. And you have to remember that at the beginning of the pandemic, they also actually let go, or not let go, but a lot of people quit working for the Internal Revenue Service. So when they say that they hired 70,000 new individuals, a good chunk of that was just replacing what they had lost prior to or at the beginning of the pandemic. So the general misconception is that the government not only is fully staffed as they were at the beginning of the pandemic, but they've added 70,000 new employees on top of that number. And that is not the case. It is just replenishing essentially the hemorrhaged employment numbers that they saw throughout the last 2 years of the pandemic. No matter what, I think that moving forward, even if the IRS does restaff and hire more individuals, they are really being hired to go after not the general taxpayer, in my opinion. This is my personal opinion. I think that under the Biden administration, they are really trying to hone in on the wealthy of America, the CEOs, the corporate owners of the world, the billionaires, or even the multi-millionaires of the world, individuals that file in the 1%er bracket. But once again, the general misconception is that the government not only hired and kept all of those individuals during the pandemic, but then they added 70,000 new employees, and that is just not the case.
I follow. Mm-hmm. What would you say would be the top five deductions available on the tax return for self-employed borrowers? In fact, I'm going to do a Facebook Live on Thursday for self-employed borrowers. So maybe you can refresh a little bit my knowledge on that.
Excellent. Absolutely. So for the self-employed individual, aside from most deductions being dollar for dollar tax deductible, there are a handful of deductions that a self-employed business owner should in fact be taking every single year because they are the most common deductions for self-employed business owners. Number one would have to be auto and truck expenses. I mean, even if you work from home, there's still times where you have to go to the store and pick up supplies, maybe to go to Kinko's or FedEx and ship out things or have things printed out. So to have absolutely zero in auto and truck expenses as a self-employed individual, that might actually look a little suspicious to the government, wondering, okay, where else did you put that write-off on your return? Is that the correct place to be putting it? Is it being limited to the 55 cents per business mile write-off? Or did you purchase a vehicle and you put it as an asset against your depreciation schedules? So auto and truck is going to be number one straight out the gate. Number two would be equipment and supplies. And equipment and supplies also entail your depreciation schedules. The reason why I really like equipment and supply purchases is because number one, how many people do we actually know who can do what they do professionally without a computer, right? Without a cell phone, without a printer? These are the most common deductions for a self-employed business owner. And if you don't have computer expenses and pens and pencils and papers and printer ink, the government's going to wonder, well, what the heck are you doing business-wise? So equipment and supplies. Number three would be office deductions. So the in-home office write-off. During the beginning of the pandemic, a lot of people were forced to move out of their brick and mortar office spaces.
Like this here behind me. Right.
Work from home, exactly. And so we are seeing already a significant spike in in-home office filings, both on the sole proprietor side of things as well as the corporation filing side of things. And so you're looking at the allocation of mortgage interest, property taxes, utilities, improvements to in-home office space, and also depreciation on the office space used inside of your home. So number three would just be the in-home office type expenses. Number four would be legal and professional fees. Any money that you pay to an accountant to file your return, any money that you pay to an attorney to draw up contracts, lease agreements for your rental investments, so on and so forth. Those would be great dollar for dollar write-offs against self-employed income. And I did want to mention that in 2018, which was another big year change for the Internal Revenue Code, that most people, I'm going to throw out a percentage here, about 70% of US tax filers aren't even allowed these deductions anymore because they are not self-employed, right? They're employees of corporations or businesses. Employees are no longer allowed to deduct their tax preparation fees, their cell phone, their online charges, meals, travel, all of that. So it gives us as self-employed individuals, even though I work for Robert Hall, I also own my own self-employed businesses, as well as my wife being self-employed. We are the individuals who have this unique opportunity to still take advantage of a lot of these write-offs. So even though somebody has told you legal and professional fees are no longer a write-off, that's for the W-2 wage earners, not for the self-employed business owners. So just understand that you have a unique opportunity to really capture those deductions when other taxpayers are not able to take advantage of those. So
just coming back to the deduction for home offices and so forth, a lot of people, as you know, the ADUs, they building ADUs not for rental but for office space for whatever business they in. That the same deduction would apply as you explained, that the mortgage interest, because obviously I have to borrow, I don't know how that does, I know whatever to build it. That would be correct?
That is correct. We also saw a significant spike in ADU and add-on square footage during the pandemic. People, living in 2-bedroom, 3-bedroom homes where they have families, they didn't have enough space to operate from inside their house. And so the unique opportunity to add another, building onto the property, an ADU, even a large kind of non-fixed storage unit that you run electrical to could technically be considered office space. It has to have obviously walls walls and a roof and things like that. But we did see a significant spike in ADU add-ons and also just added square footage in general to homes. And that was a big added deduction against self-employed income for office space. Now with ADUs, there's a unique opportunity to take a good chunk of that ADU build and accelerate the improvement depreciation amount against self-employed income. It really is, it's case by case scenario, because I would need to take a look at how the ADU expenses map out, what the square footage was, where the ADU was, if it was actually office space and not a rental property. So it is case by case, but there is a very unique opportunity to take a large deduction for an ADU build to offset self-employed income. So I love seeing those on tax returns these days. Those are great overall tax shelters.
Right. Now, that I'm dealing with a lot of realtors, and realtors are basically self-employed. They're working on 1099. Even some companies now offering W-2 income for mortgage lenders or mortgage officers, loan officers, or whatever. What would you say the most real estate professionals are? Are they self-employed or they employed?
Oh, absolutely. I'm not even going to go out on a ledge and estimate. I'd say that 98+% of realtors are 1099 self-employed individuals. The only people who kind of sit on the fence and toggle between W-2 and 1099 are realtors who also manage their own offices. I have a lot of clients who are the managers of their individual offices. And so from the broker like Keller Williams or Compass or Dilbeck, they W-2 the team manager for that compensation, but then those managers also list and sell property on the side. And so they have that commission income as well. So having a little bit of a dual income overlap is pretty common, but not for just the general out the gate realtor. It's mainly for the individuals who are involved in the day-to-day operations of their office itself as a manager, as well as being a realtor. But 98+% of realtors are just straight up 1099 commission earners. And so these top tax deductions, these are great ways to shelter a lot of their income.
Right.
And I do want to mention number 5. So number 4 was legal and professional. Number 5 would be probably the most important deduction for your business, which is marketing and promotional expenses. We saw same with the in-home office deductions and how many forms we saw, the number of forms filed increased during the pandemic because people were working from home. We saw a significant spike in marketing and promotional expenses. With interest rates being so low and locked at that low rate, my realtor clients were busier than ever over the past 2 years. And so they saw the need for marketing and promoting their business. So we just saw, I'm talking about 3-4x minimum in overall marketing and promotional and branding expenses. That industry just shot through the roof, the marketing and advertising industry. So that is going to be a dollar for dollar adjustment to offset self-employed income. And what better way to reinvest your money back into infrastructure, to promote yourself and be able to write off that expense and shelter that money against any federal or state taxable income.
And generate more business, right?
Yep. Mm-hmm.
One of the questions I have here for you is, what would you recommend for a realtor, a person who perhaps just starting out in a business? And we know that a small percentage of the realtors who starting out in the business have become very, very successful. Would you recommend for them to form an LLC or an S corporation, or what would you recommend for them to do?
So this is some general misinformation and a general misconception in the self-employed industries, where as soon as you start a self-employed job that you should incorporate. And some people will advise professionals to do that. Personally, I believe that there's very much a right and a wrong time to incorporate. If you are just getting started in the real estate industry and you have, let's say that you've had 1 or 2 closings, so you've got $20,000 or $30,000 in commission income, there is absolutely no reason for you to incorporate yourself at 20 to 30 grand in self-employed income. It would end up costing you more than it's saving you. Okay. And the whole goal here is for an incorporated entity not only to create greater asset protection for you as a business owner, but also to give you a little bit of tax sheltering benefit. I'd say that after 16, 17 years that I've worked in the tax industry, that the net revenue amount that you need to hit as a self-employed realtor needs to be at or above $45,000 to $50,000. This is not your gross commission. This is actually after you've deducted all of your expenses. Your profit needs to be at or above 45 to 50 grand for it to save you more than it's costing you. And this particular entity would be the subchapter S corporation. So this is a very unique entity, and it allows you to reduce your self-employment tax, because as a self-employed individual, you get hit with this 15.3% of Social Security and Medicare tax every year on whatever your profit is. The S corporation will allow you to reduce that by upwards of 60%, not 6%. But 60%, it could save you tens of thousands of dollars in unnecessary tax.
So would you recommend someone who is making more than perhaps $100,000 gross, okay, to either form an S corporation or an LLC, or what would you recommend for them to do?
First suggestion right out the gate is to have a conversation with a tax advisor to make sure that it's right for them. I've run into situations where the numbers all make sense, the tax savings make sense, but the taxpayer themselves, they don't want to complicate things. They don't want to file a corporate tax return and a personal tax return, no matter how much it's saving them, which is silly to me because that's what people come to us for, is to save them money. But it's not right for everyone. From a personal standpoint, it's not right for everyone. But I'd say that 9 out of 10 of the clients that you meet with in a day-to-day basis, when you see those numbers and they make sense at 45 to 50 grand or above, or even 100 grand gross, depending on their overhead, a subchapter S corporation would make so much sense because otherwise you're overpaying in Social Security and Medicare tax, and you're basically flushing money down the toilet. Let's try to retain wealth and not end up paying that wealth back to the federal government. So that would be my suggestion. That is, if your net revenue is breaching that 45 to 50 grand, at least pick up the phone and call a tax advisor and see if it's right for you. We map out everything that entails, what the annual filing fees are, what you owe the state of California, what your filing requirements are, what the deadlines are, what it involves as far as payroll is concerned, year-end planning. And at the end of the day, when we add up all of those consulting fees, filing fees, and everything, remember the goal with the subchapter S corporation is to save you more than all of the costs that you'll incur by being incorporated. And right at about 45 to 50 grand in net revenue, that's where it ends up saving you almost double what it's costing you. So that's the number that we really need to dial in to make sure we're pointing you in the right direction.
By the way, what are the filing fees now for a subchapter S corporation?
Sure. California has the highest filing fee in the United States. It is $800 per year. I call it the parking ticket here in the state of California to park your business in the wonderful state of California. It's $800 minimum. If your net revenue through the business is above $53,333, you owe the $800, which covers the first 53 grand of profit. And then you'll owe a 1.5%, what's called a net revenue tax on every dollar above $53,333. That $800 is 1.5% of $53,333. Right. So you owe the minimum $800. And then every dollar above 53 grand is 1.5%. And that's your corporate tax. The filing fees on the preparation side, our firm charges roughly about $11.99 for an 1120 S corporation. Individual tax preparation starts at about $7.99. And based on the amount of forms that you have that you file, that then the price could be a little bit more. But remember, the goal here with the 1120S is to save you more than the California fee, the payroll filing fee, the preparation fee. So if you're talking about 2 or 3 grand in filing fees per year, incorporating alone at 45 to 50 grand in net revenue is going to save you close to 6 grand in tax. So obviously, if it's going to cost you on the high end 3 grand to file, but it's saving you $6,000, you're not only covering all the costs of filing, but you're actually retaining another 3 grand of your wealth that you've built for yourself throughout the year.
Absolutely.
That's the goal. That's the calculation.
It makes a lot of sense to do it then, right?
Absolutely.
A lot of the, even though we have the pandemic and we don't drive, as you said at the beginning, we don't drive as much as we used to do it. But still, self-employed person and realtors, they have to replace the car because they driving perhaps clients or meeting clients and so forth. What would you recommend for them to do versus leasing and buying?
Sure. Leasing and buying, it's a very unique conversation because leasing, in my personal opinion, is more of a lifestyle choice. You want to be able to return that new car every 2 years, get a brand new car, not have to pay for maintenance or repairs or anything. That's the benefit of leasing somebody else's asset, right? And sure, leasing is a great, consistent kind of lower write-off per year. And depending on if that's your only vehicle or if it's maybe a second vehicle, you might be able to deduct the lease payment at 100% write-off against your self-employed income. But if it's your only vehicle, you have to allocate what time is used for business, what time is used for personal time. And when you start to allocate that percentage, you have to be reasonable, 40% personal, 60% business, or however you're allocating. And then you're limiting the overall lease deduction write-off. Whereas the purchasing of a vehicle could allow you to take a much larger upfront write-off, allowing you to save more tax in this year, and all of that tax savings you're able to reinvest back into marketing and promotional and in-home office space or whatever you're going to spend that money on. But purchasing a vehicle allows you to take, once again, a much larger upfront write-off. It all comes down to the weight class of the vehicle, though. So if the vehicle that you're purchasing, not leasing, but purchasing, weighs under 6,000 pounds, in the first year of ownership, you qualify for a bonus depreciation amount of $18,000. Essentially, you're getting an $18,000 write-off all in the first year, and the remaining value of the vehicle is depreciated over the following 5 years, or over the next 5 years. So you get that large 18 grand write-off in the first year, and then you have to spread the remaining amount over the next 5 years. If the vehicle purchase is over 6,000 pounds, you qualify for something that's new as of 2018 called 100% bonus depreciation, which makes that 6,000 pound or heavier vehicle possibly, once again, depending on if it's your only vehicle or if it's a second vehicle, it could possibly trigger a 100% write-off for the value of the vehicle, meaning that you go out and you buy a Chevy Tahoe, which is well over 6,000 pounds, for 65 grand. That $65,000 valued car is a dollar for dollar write-off against federal taxable income. That's a $65,000 write-off, even though you might have only put 5 grand down as a down payment, finance the rest. Nonetheless, you get the full $65,000 as a write-off all in 1 year. Not everyone will qualify for that benefit. Once again, depending on if they have one car or multiple vehicles. If you have multiple vehicles, you can say one vehicle is for personal use, the other vehicle is solely for business. But if you are a single filer and you have one vehicle, you have to allocate business versus personal usage, which then will limit the deduction. But at the end of the day, purchasing is going to give you a much larger write-off. And at the end of the day, you're paying into an investment that you own and that not that somebody else's own. Even though it's a depreciating asset, I still feel like, financially speaking, in most cases, once again, 9 out of 10 times, owning is a much better option for individuals.
Just another question about if it's an electric or a gas, what any difference in deduction? That's what I'm getting.
So only certain electric vehicles still qualify for the credit, and we're still waiting on Biden's administration to release the new list of EV credits for 2022, because we don't know what cars are going to have the credits for this year just yet. But Tesla ran out of their credits, I believe, in 2019. There's still the Chrysler Pacifica hybrid that qualifies for the credit. But there's a whole list of EV vehicles on not the IRS website, but there's a special website that you can go to that gives you a list of all of the automakers that still have credits that you can qualify for in 2021 or 2022. So there are still some. I know that one vehicle on that list is the Porsche electric vehicle that qualifies for $7,500, but it's like, okay, well, not everybody can afford 130, 140 grand electric Porsche, right? Mm-hmm. So there are very few vehicles that still qualify for it, but Biden's administration is talking about adding a lot of vehicles back to that list. And we're still waiting to hear about what vehicles are going to be added back onto that list.
Because it seems to me that the electric vehicles getting promoted so heavily, and the more and more manufacturers, getting on board, and they say that, I don't know, that electric cars will be, 25, 30% in the next 5 to 6 years.
So supposedly California has a bill in place already that I think don't quote me on this, but I believe by 2032, they will stop selling gas production production cars that are gas. I don't know how to say that, but gas production cars by 2032, meaning that from there on forward, California is only going to be allowed to sell in this state electric vehicles. So, once again, I don't recall if that is the correct year. It's just off the top of my head. It might be 2040, but it's the writings on the wall. Certain states want to make sure that we get rid of the gas vehicles. I know that China has already moved very quickly to remove all gas powered vehicles from their roads because they see the benefit of creating less pollution. It's just the future of the automotive industry. And so you see a lot of these large automakers coming on board with making their own electric vehicles and no longer making those gas powered.
I read a funny story. In Norway, this was last week, I got hundreds of emails. And in Norway, somebody who had a Tesla, the battery gave up the ghost, and they had to replace the battery. It cost $18,000.
Yep.
And this person blew up their car.
Yep. I saw that exact article. I read that exact article. Because he's like, why would I pay 18 grand? I might as well just put that 18 grand down on a new vehicle. Yeah. So we are very much in the time. If also individuals, kind of a comparable example, if you all remember what the first iPhone cost, right? It was $1,000+ and the technology in that first iPhone was nothing like the technology in the newer iPhones. And sure, the new iPhones are very expensive, but they have options to insure the new iPhones. They have a buyback plan for a lot of the new iPhones. So electric vehicles are so new, especially with the Teslas, because even though Tesla's been around for quite a while now, they are still in the beginning phases of producing a lot of these vehicles in mass production, at least. Sure. You might see them everywhere on the road, but they are not producing as many cars as the Toyotas of the world, as the Hondas of the world. Yeah. So once the production really kicks in and they fine tune that process, I do believe that the cost of replacing these things will go down as well. And there will be more efficient options. The battery technology will be better. But yes, you are absolutely right. If something dies on your car and it's not insured or it's not backed, or maybe you didn't buy the warranty or the correct warranty, who knows, right? But yes, I do recall seeing that article at 18 grand for a new battery, and he blew it up.
That was fun. Tony, we're just about getting to the end of our time. Is there anything else perhaps you can recommend to once again, to realtors, self-employed people that they need to be aware of, even though that some of the text, it hasn't been implemented yet?
Absolutely. I just want to mention two quick things. One, do not be afraid of taking in home office deductions. I can't tell you how many people have come to us over the past, over the past 16, 17 years that I've worked here, but mainly over the past 2 years, and said, hey, I'm afraid to take this in home office deduction, even though it's a true deduction, even though I'm working from home. In the past, accountants have told me that it has a higher risk for audit and that I shouldn't be taking it because people fear the IRS. Remember that the in-home office deduction part of the Internal Revenue Code is a whole 2 or 3 page part of the IRC. It's a legitimate write-off for you to take. You just have to make sure that you're being reasonable with the square footage you're allocating for in-home office space. That's where people get audited. It's not the actual deduction that is not ordinary, necessary, and legitimate. It's the allocation of square footage that people tend to use. People want to use 30, 40% of their home as office space, but that's just not a reasonable square footage allocation unless you run an Amazon type business out of your house, right? Where you use your garage for storage, you use 2 bedrooms, one for your office space, the other for maybe, printing and postage and things like that, which is it's uncommon for that to happen. So just be reasonable with the allocation and never be afraid to take it as a write-off, because the in-home office deduction meets all of the requirements for it to be a write-off. It is ordinary in business, it is necessary in business, and it is very much a legitimate write-off, which passes what we call the smell test here in the tax industry. It passes the smell test 99.9% of the time, but you have to be reasonable with the allocation. That's number one. Number two, understand the differences. Before you incorporate yourself have the conversation with a tax advisor, with an attorney, whoever with your priest or your religious advisor, whoever you trust the most. But understand that the advice changes when you go to an estate attorney, when you go to a legal attorney, when you go to a tax accountant. We want you to set up certain entities to save you tax. Right? When you go to an attorney might push the LLC, might push the C corporation for asset protection purposes. But when you come to see us, we're going to convert that entity into an S corporation to save you tax. And at the end of the day, the attorney should have no problem with that because we're getting the best of all worlds now. We're not only allowing you to separate your business and protect your assets separately from your personal social security numbers, but we're also getting the best overall tax sheltering benefit by filing as an S corp. Now, when you go to your estate attorney, the estate attorney is going to want to put all of your entities and all of your assets under your living trust, which is great. And that is something that I absolutely suggest, especially if you have family, especially if you have legacy that you want to leave for your loved ones and protect it from probate here in the state of California. So the proper structure is to obviously have a great insurance policy in place for your business, but have that business incorporated under an LLC, taxed as an S corporation, per the advice of a tax advisor. And then the owner is no longer you individually. The owner is your living trust. And that way you are protected from every angle, from litigation, from probate. In case anything happens, your insurance policy is there to cover you. Hopefully, we all hope that insurance is there to support us. So just make sure that you understand the proper structure. And that's the most important thing, is that we want to protect and we want to save. That's all.
Well, Tony, thank you very much. So, you got a wealth of knowledge. Thank you for sharing with us. And the information is so important, especially before the tax season, to people to understand really that they do need to talk to a tax advisor or a tax preparer, whoever they're working with, because otherwise they're just going to pay a lot to Uncle Sam. Right, so that's the reason you need somebody, and I don't think the cost. Whether you mentioned about 700 or something like that for personal, I don't know if you save a few $1,000, that's that much, or if you're in business, you do have to pay the corporate filing fees and so forth. Anyway, I just want you to know that Lou was right. You are awesome. You are very, very good. Thank you very much. This is going to be all over the world at this podcast, and hopefully you'll be able to get some business. I can't promise anything because I never know how the people are going to react to it. But anyway, I just want you to know, thank you very much once again. And I really appreciated your time, and all the best to you.
Thank you for having me. Absolutely. Happy New Year.
Oh, yeah. Still the second thing. Happy New Year to you too. Take care.